conversation about debts when it comes to purchasing a home. That is probably one of the hurdles that I see in today's lending environment, is people that have debts, and what debts do we actually look at when qualifying you for a mortgage. So obviously anything that reports to your credit report is a debt that we're going to look at. That can be credit cards, it could be student loans, installment loans, auto loans, things of that nature. So if you're getting ready to purchase a home and you have debt, what debts are the most important to concentrate on to either pay off or pay down? I mean, we can get pretty in depth in that part of the conversation, but I just want to make people aware. What we see is like student loans. When it comes to student loan debt, there's so many people that have that debt. It's amazing. It amazes me how much student debt is out there. And when it comes to loans, mortgages, you may have it might be deferred. It shows zero payment, right? If that's the case, in most cases, not all, but most cases, we have to count a payment, even if it shows zero on your credit report, deferred for however long, or in forbearance. We have to count a minimum of 0.5% of that balance. So we take 0.5% of that balance and use it as a monthly qualifying debt. And that could be significant depending on how much student loan debt you have. So keep that in mind. I mean, there are some certain programs, one of the conventional investors, if you're on an income-based program, and sometimes that income base can be zero payment, then we wouldn't count the payment. We'd count zero because that is your actual payment. But depending on the loan type, we may have to count 0.5%, and another investor requires 1%. And then VA loans, a whole different calculation. It's not based upon the same calculation as conventional and FHA. So student debt is heavy. That can definitely affect your buying power. The other thing I see is auto loans. My goodness, they've gotten expensive. I see some big auto loan payments, and that of course will affect you. One of the things that I've noticed in some cases is a lot of these auto loans are joint auto loans. Like it might be a spouse, or it could be a significant other, that you're both on that auto loan. And if the scenario is we're not utilizing or can't utilize the spouse or significant other to be on the loan, we still have to count that debt against the borrower that is on the loan because it's a joint debt. The only way we can get around that, depending on loan type, is if we can prove the other party is making that payment for the most current 12 months out of their own assets, not a joint asset. So that can get a little tricky. So we can plan ahead is what I say. Is let's sit down, look at your debts, look at strategically how to put you in the best position to buy a house. Let's see. The other thing is what debts to pay off. Certain debts affect credit score, of course. Your open accounts, revolving accounts, higher the balance to the limit, is going to hurt your score more. Of course, late payments for sure, but so which ones would I say to pay down? Well, ahead of time, if we can look at it, and we can strategically look at it and say, if you have an installment loan, and let's say it's an auto loan, and if there's less than 10 months worth of balance left on that payment, then we don't have to count it. So I wouldn't want you to pay off an installment loan that has less than 10 months on it, because we don't count it anyway. And then once you pay off that installment loan with a little bit of time, becomes a closed account that can affect your score negatively. So installment loans, be careful on paying those off all the way. Maybe pay them down so there's less than 10 months payments left. That would help. And And then the credit cards, for sure, pay those down to keep your score up. So let's see, that's my thoughts. Oh, and the other thing on bank statements, an underwriter these days, so we have to be careful of what assets we're using. We obviously have to provide the bank account, the bank statement, all pages to it. That's one of the tough things, is getting all pages to a bank statement. Some borrowers think if it's blank, you don't need it. We do. So an underwriter is going to analyze line by line on that bank account to see what's going out and what's going in. So if they see a payment to whatever, it could be a credit card that doesn't report to payment, and a lot of time, or to credit. A lot of times these pay-as-you-go or deferred payment loans don't report to credit, and depending on the scenario and how many months are left on it, we have to count that debt, and it's going to be questioned if it's on a bank statement. So keep that in mind. We may ask for explanations on what's going out or in your bank account, and we're required to do that by the investors. So the other thing is to maybe we simplify the documents. Sometimes that's easier, so we don't have to. These are legitimate explanations on things that might come up. It's not a problem. It just creates more work. So, and more work for you and me. So sometimes if we're not needing an account in the file, we just leave it out. We're using the asset we're using to buy the house. That's what we're documenting. So we might only want one bank account and not all 6 that you have. But if there's money going in and out of those accounts, depending on the size of those deposits, if you're transferring back and forth, we may require that other account. So it's going to be important to, initial consultation ahead of time. Many times I get people coming in that because they saw a house, they want to write an offer now, and then we analyze their financials, and then we have to overcome some hurdles that if you would have met me, a couple months earlier, they wouldn't have been a hurdle. So that's my 2 cents on credit debts and qualifying for a mortgage, and have a great day, everybody. Take care.